Welcome to Season 3 of Hines on Air, a new space for voices with something to say where conversations are recorded and remembered, hosted by Matt Hines.
Coming at you from Atlanta, Georgia, welcome to Hines on Air. Hey everybody, welcome to another episode of Hines on Air. Today we are getting into the fascinating topic of money lending. All right, and we've got an expert on hand who's going to tell you about the history of it and tell you about what he's doing now. This is Mr. Joseph Castaneda. Welcome to the show, my friend.
Matthew, thank you very much for having me. Appreciate it, brother.
We're excited, man. I'm glad you're here.
Yes.
All right, good. So we've been talking a little bit before the program, so we got a little bit of data from each other, but you started this you started your history with money lending back in 2005?
Correct.
Where were you working then, or what were you doing?
So we were part of a company that was assisting countrywide with originating loans. And so at that time, I had jumped into financing because I was a firefighter in the Florida Keys. So I drove up and down overseas highways. So I had a lot of time on my hand and I love numbers. And so I deep dove into real estate financing.
How was the company helping countrywide? Like, what were they doing?
We were doing remote closings. At that, Florida is a title state, so you don't have to close with an attorney. You just have to close with a notary.
Yep.
The title company would draw up the documents, and then we would assign mobile notaries. Say, hey, go to West Palm. Hey, go to Tampa. Hey, go to Orlando. Execute 300 page.
Dude, it's funny you say that because I started my firm in 2004. I was broke. Like, it was not fun. And I paid a whole lot of mortgage payments with those witness closings.
Yes.
Because, I did the attorney ones here because we were an attorney state.
Yeah.
But I'm familiar with what you're talking about.
Right.
Witness closings, whatever you want. Signature, we call them all.
Mobile notaries, yeah.
Mobile notaries, man. And I paid a whole lot of bills
and
for those things.
We were doing about 150 to 225 closings a month. Like, it was just that boom. Like, everybody was just getting approved. If you had a pulse and you were breathing, like, you're like, let's go. And not just one, but many loans to just one individual.
Did you see any problems with the loans back then? Did you feel like the 2008 was going to crash, or was it everybody just oblivious to kind of the coming storm?
We were oblivious, I'll be honest with you.
Yeah.
Yeah. Because it was like too good to be true. And if the bank is approving it, like, we're not gonna challenge the bank,
right?
You're gonna be like, if the bank says yes, let's keep it going. So, and we were under the assumption that the underwriters were doing what they're paid to do, underwrite. They need to run a fine comb through all of the borrowers, and if they're like, check, yes, all the boxes are checked, fund it, and we're like, okay, good, keep it going.
That's true. There's no reason to rock the boat, I guess. If everybody's happy and making money, somebody's getting a house.
Right.
Somebody's making some brokerage fees.
And the same thing with you guys. If the title comes back clean and everything's good to go, you're not going to say, hey, no, right? You're going to be like, oh, everything pans out. You have your error and omissions. You have title insurance. We're rocking and rolling.
Let's rock. The only thing, we talked about this a minute ago, but I remember the adjustable rates. And I'm sure most of the audience knows that's when you get in at I think they were getting them in at like 5% or so, and then they adjusted to like 9 or 10%. And that doesn't sound like much. So that's a big change in the monthly payment for people. Could be thousands.
And not just thousands, but when you have multiple loans,
right, it
just blows up in your face.
Yes.
Mm-hmm.
And we'd be closing those adjustable rates with good families and all. And they're like, yeah, Matt, we're gonna close on this one. And refi in 6 months because we're going to get our credit up. Because that's what the loan officer told me. And I'm like, I don't know if it's going to happen. But okay, man, I wish you the best. And apparently it didn't go as planned for a lot of people.
It didn't, because life happens.
Yeah.
Right? You're assuming or that something's going to work in the near future, and we don't have that magic ball, right? You're going based off, now the emotions, and not going based off the economy.
Yeah.
What could happen? And that's what happened, yeah.
Yeah. Well, to the average family, if you're told your mortgage is $2,500 a month and then it goes to $4,000 and you can't refi again, that's a big hit.
Right. That's where nobody saw that.
Right.
That big influx of payment. And not even that. I mean, if you're like, let's say in Florida, where every year your taxes are going up, your insurance is going up as well, and you caught that loan, let's say you closed in November, here comes the next following year, taxes go up, and you're like, I don't even have that. Then the adjustable rate kicks in. Now you're stuck.
I got you.
Yeah.
Well, cool, man. All right, so you survived the crash. So congrats to you.
So I survived physically. I'm here.
Yeah.
But everybody took a hit. I lost as well.
I went bankrupt.
Yeah, exactly.
Yeah.
So it was...
Because our first firm was all real estate closings. And Countrywide was our main client.
Yes.
We had 3 of the major branches here in Atlanta.
Yes.
So we were closing.
So we had one of our biggest also clients was Boston National Title. Mm-hmm. Do you remember them by any chance?
Nah.
Boston. So they were huge, and they were one of the biggest title companies for Countrywide, and they were just funneling them all type of files on a monthly basis. But yeah, they went down too. Everybody just really took a crack at it.
Yeah. Mm-hmm. All right. So right now you have your own lending company, correct? Right, yeah. All right. So I tell you, we can jump to now our present time. So what does your company do now?
So I'm the managing partner of Duke Allen & Company. We're a private lending firm here in Atlanta, and we service investors on their financial needs. So if they're looking to do a fix and flip project, buy and hold rental, new construction, even transactional funding for same-day closings, for like double closings for wholesalers, we have access to capital for that.
All right. Now, we were talking before the program, and you said something interesting because you were like, a lot of these people, they go to Chase or they go to Bank of America, and he's like, that's the wrong move. Give me that situation, because that's stuff people need to know.
Yeah.
Because Bank of America is tough. I've made applications with Bank of America, and I'm like, this is going to just go through so easily, and then they come back and like, Matt, you're not qualified. Right. I'm like, what the hell? Like, what?
So what's funny, Matt, is that when you go in as Matthew Hines, they look at you different than when they look at you as Matthew Hines LLC, right? So they're very investor friendly to LLCs, to companies, versus individual personal guarantor, right? So it's 2025, Matthew, and there's so many people that don't understand what a hard money loan is. We're 2025, and hard money has been out for ages, and so hard money loans are strictly for real estate investments. Not that you're thinking of using a hard money loan to live in a house that you're going to fix and flip. No, this is for an investment. And I'm going to let Matthew Hines LLC borrow this liquid, this capital, however you want to call it, to purchase a property, fix it, and then sell it, or with the intentions of keeping it. So we'll refinance, right? So that's what we do as a hard money lender.
And that's for residential, commercial, any sort of investment.
Any sort of a real estate investment. As long as it's attached to a hard asset, I'll be able to finance it if the numbers make sense.
Okay. And what's the typical term for somebody if they came to you?
Sure. Okay. So just to qualify, we would need an entity. And you could create an entity today, and it could be approved through the Secretary of State of whatever state you're investing in. In 10 days, I'll be able to lend it to that entity. That's one. Two, for a fix and flip loan, let's just call it that, I could finance you 5 times what you show me in your bank statements. So if you have $50,000, then I could get you a pre-qualification letter for $250,000. Now, let's say I'm your partner and I also have 50. Under that entity, we have 100 combined. Now you're fundable $500,000. So you could make the deal make sense if you bring certain partners. And who's to say that we can't partner up, right? That we just met today and say, hey, let's get into a new construction project. And you're like, yeah, I show you numbers. It makes sense. Good. Now we create an entity. And on the operating agreement, we have members. The operating agreement is going to state who are the members and what percentage each member owns. 50-50, great. We take this to our capital partners, our capital markets, and then we'll show them, hey, this is the appraisal. We're fundable. We have X amount of thousands of dollars in the bank. And it doesn't even have to be seasoned. That's the cool thing. And once we bring that up, they're like, okay, yeah, you're fundable $500,000. You need $400,000. Get me 10% of your budget. Of course, we have 10% of 400, which is 40,000. Combined, we have 100. Right. So, of course, now you have attorney fees. You have title insurance. You have property taxes that you pay. And then builder's risk to protect the lender. We're closing.
Wow.
Yeah.
It sounds too easy.
It sounds too easy because I've been in the industry for so many years, right? But to everybody else, it's like, oh my God. I go, no, I'll explain it to you because I want to make sure that you feel comfortable with the terms that you're signing up on. Now, these are high interest loans, right? So you want to be in and out. That's why it's called fix and flip. You fix it and you flip it quick. The beauty of it is there's no prepayment penalty. So if your terms are for 12 months and you purchased a property, you renovate it, and you sold it in 5, well, you only pay for 5 months or to the date that you held that loan for, and you're out. Good. Now, we sit down and we explain to you, hey, listen, it's all good and dandy that, oh my God, yeah, after I could make 50 grand. I'm like, well, let's talk about numbers. On the back end, when you sell it, you have to pay back the loan with your carrying cost, which is your interest rate, right? That's one. Realtors, they don't work for free. So you have to factor in 6% on the sales price. We're in a buyer's market. So now how can I sell my property versus the other property is, hey, I'm going to contribute to closing costs. So go ahead, factor in 3%, right? And then your initial down payment that you put, whatever is your net, then let me ask you this. Do you have a partner in your LLC? No. Well, actually you do. Guess who it is? Uncle Sam.
I was about to say the government.
The government.
Okay.
Yeah, you want your capital gains.
Yeah.
So after everything is said and done, are you in the green or in your red? So I'm going to explain to you, my client, say, hey, listen, you're giving me this. I'm going to explain to you if this is fundable or not. So you make your money on the buy, on anything. So I want to make sure that if you're bringing me a single family home, can you negotiate it as good as you can so it could be fundable? Because after everything is said and done, after you've spent 4 months of babysitting grown men and women, making sure they're on your site on time, making sure that they bought their tools, their whatever it is, was it worth the squeeze? And so that's what we go with that every time we're with our client.
Do you know how to help somebody, a potential investor, analyze the situation to say, I don't know if this is good, or like
that's our job.
That's your job.
That's our job. Remember, okay, so we have a client and we have a borrower. Our borrower is the one that comes for financing. Our client is the one that has access to liquid, to capital, right? So I have to make sure that their money is secured by the house and it makes sense. Right. How do we determine that? Is through an appraisal. We could do a desktop appraisal, or we could have an actual appraiser visit the property, take pictures, make sure we count how many rooms, how many bathrooms, measure the house, the measurements, how many square feet. Is it a 2-story, a ranch, a basement? And then check with public records to see if it matches. Because a lot of people do illegal work to the property. They'll add maybe a bathroom or 400 square feet. Then we're going to verify with the county if they pull permits. If it doesn't match up, we're going to tell them, hey, listen, we feel that this is too high risk for you because there was an addition done without permits. And so if there was an actual fire caused in that addition without permits, the insurance company is going to say, this was done incorrectly. Figure it out on your own.
Wow.
So that's our job. We have to make sure that once we do our underwriting or preliminary underwriting, that it makes sense. They're in the green.
Could you put a number on the number of investors that come to you and are unable to get rid of the property? Or have you already analyzed it so well that they can kind of roll with it?
So we don't have a crystal ball. Right? The market shifts every day. Somebody could say something crazy on social media and then it tanks for whatever reason. Or we could have, current events, in Europe or Asia that just crumbles the whole market, right? So now, have we taken back properties? That's the biggest question.
I gotcha. So you just foreclose on it.
We just foreclose, right? You see, so what happens is we're not just only lenders, but we're also real estate developers. So when I speak to my clients, we speak as an underwriter and an investor. So when somebody brings me their scope of work, I'm going to look at what you're trying to do and based on what you actually put on your scope of work. Your scope of work is your renovation budget. It's going to tell me where every dollar is going to go in every line item. Demo, portable toilets, dumpsters, grading, removing trees, anything up all the way down to a project management fee. So when I look at that in actual pictures from the appraisal, I'm going to look, okay, well, you're asking me for 15 brand new windows, but I'm counting 20 and you need 20. Hey, do me a favor, adjust this. Because once you sign on the dotted line, anything over your budget comes out of your pocket. Mm-hmm. So right now, the average window is probably going to cost you materials and installation about $350 to $425. And if you're missing 5 windows, it adds up.
Yeah.
Right. And on top of that, you still have to pay your interest only payment on a monthly basis. That plus everything else, like, you don't want to be in the negative.
Did the whole COVID supply chain fiasco hurt y'all's clients?
No, because that's when investors go out to play.
Yeah.
Yeah. Yes. Yeah, because at that time, those people have inventory. Meaning, let's say a lot of my clients came in and say, "Hey, I'm buying somebody's property because they're tired landlords, and they're giving me a great deal on it." Yeah, I could go ahead and finance the purchase, the renovation. Once you've renovated and you put a tenant in there, I could refinance you out of that high interest only payment into a DSCR 30-year loan. And that's when everybody was going out to play. Those investors know when to invest, and those were the best times.
Were the best times.
Yeah.
No kidding.
Yeah.
Tell us again about what's the abbreviation you just used?
DSCR is called debt service cover ratio.
And that's the no income, no verification?
Income verification, tax returns, transcripts. We don't verify employment, none of that.
What kind of rates are those getting?
Right now, we just quoted at 5.75%.
That's good.
It is good, right? Because it's
for those type of loans, especially
because now it's not a fix and flip loan. Mm-hmm. It's a 30-year amortized loan.
But I got conventional loans that are 6.5 and stuff.
Right, because that's primary use. My loans are for investor purposes only, meaning my investor or my borrower is not going to live there.
But I thought those were higher rates.
That's the thing. People are thinking, they're assuming that, oh my God, well, yes, for fix and flip, always going to be higher because it's short. It's fast money. It's short-term money. But when you're talking about amortized to 30 years, oh no, we're very aggressive with that. Absolutely.
Very cool. Okay. Well, cool. So the typical situation that you're working with people on is they just find an investment property and they want to get in there, renovate it, and flip it quick. Are there any other types of deals that you're working with people on?
So new construction is big. We are also investors, so we understand what the process is on the borrower side and also as the underwriter. And when I say underwriter, is the lender, right? So we analyze deals. Any deal that I get into has to make sense for me because I know that even though I'm the investor and also the lender at the same time, I have to still pitch this to my capital markets. They're still going to ask me for the same appraisal, the same budget, and somebody's going to review those docs to make sure that, hey, they're going to trust me, but they're going to verify what I'm submitting, right? So the appraisal is going to tell them, hey, this is the as-is value right now in this market, and then what we think is going to be maybe in 6 months or 12 months, right? Because if I'm buying a property that is in a distressed situation, the value's here. If I'm adding 70,000, value's here based off comps. Right now in this market, within half a mile, sold comps, not active or pending or expired. These are actual comps that sold with similar square feet, similar floor plan, and in the last 60 days. 6 months, which is 180 days.
I got you.
Mm-hmm.
Okay, cool, man. So, What did you do? All right, you might have already answered this. Like I asked you earlier, people come to you because they failed with the Chase application or Bank of America. Why is it better to go through the hard money approach versus the conventional loans? And I apologize if you answered that. But
No. So that's a great question. So conventional loans is for primary use.
Right.
FHA, VA. USDA, which is 100% in rural areas. Conventional. That's for you to live in it.
Well, but they do investor loans and second mortgages and all that kind of stuff too, right?
Yes and no. But they're going to ask for full docs, transcripts, W-2, last 2 years of tax returns, and the whole nine.
Yes,
right?
They do.
Correct.
Yeah.
On the investment side, because they know they're not going to live in there, it's show me liquid. Show me 2 months of bank statements. Show me a deal that's profitable. Experience or no experience. What's going to determine if a deal makes sense or not is the evaluation, the appraisal. Your credit and your experience on paper that you could show me HUDs that you've flipped a house is going to determine your rate and terms. That is it. The only way I turn somebody away is if there's issues with title. Right. I mean, if there's if it's gone through probate, somebody passed away, probate could take months. It could take years. If you got 2-3 heirs, then if they all got to say yes,
that's right.
If one says no, there's no deal.
Right.
Right. Or if there's fraudulent activity from the borrower. Bankruptcies, we get its life. Foreclosures, we get its life. That's doable. A letter of explanation saying, hey, listen, I went through a hardship, this and forth in 2009, whatever. Cool. That was like 14, 15 years ago. But if we just funded a client of mine that had a bankruptcy, but it was already discharged, letter of explanation. We had a letter from the judge saying it was already closed. It was discharged. Good. You're liquid. Yes, run it. Why? Worst thing that could happen is, it's not even that. The worst thing that could happen is like it could get burnt out or flooded. Well, we have insurance to cover that. It's good. The worst thing that could happen is we take back the property, we fix it and flip it ourselves.
Right.
The money's not lost. It's secured in first position.
Right.
So all day, that's not a problem. The thing is that Chase, Bank of America, U.S. Bank, PNC, they're very strict on how they lend their money. And if it's an investment property, it's too high risk. They don't want to deal with high risk assets.
I got you. So what do you see the rates doing? Any prediction there? Were you watching all that?
To be honest with you, I don't drink the Kool-Aid. No, if that's the case, then I won't go out the house because I could get a cold, I could get a flu, COVID, whatever, right? My meter is, does the deal make sense right now? Are you buying right? Are you in a good market? If it makes sense now, the future is the future. We could have a hell of a great market in a year from now, but we could also tank.
Right.
So is everybody just stagnant? Are they stuck? No. They're buying now. I mean, Warren Buffett, he's liquidating, but he's also buying. If he's being stagnant, then that's when everybody's like, oh, like there's something to look out. But he's making moves. And if he's making moves, everybody should be making moves as well.
And you think he makes moves just because, I guess like you're saying, we just don't know the future. Like, there's no use in waiting on to see if the Fed's going to reduce the rates or waiting on that or anything like that. Or
the thing is, he's got a lot of resources, and it's not just money.
Yeah.
He's got a lot. He's got a solid system, a solid team that has maybe inside scoops, right? That we don't have, right? But if he's moving, it's because something's going to happen.
Yeah.
He's not just going to be like, oh, no, because I'm the richest man in the world, whatever you want to call it. No, he's still moving at his age for a reason.
Yeah.
And that's because, hey, I'm still moving. People are also liquidating because of that. Like, people are buying blocks. They're buying portfolios. Why? Oh, no, it's not because the market. No, it's because they need to move that money because that money is losing out on inflation. They have to invest in something that's giving them something in return.
Yeah.
A lot better than 4%.
Yeah.
Right?
You think real estate's one of the best areas to invest your money?
Secured, yes. Absolutely.
Yeah.
Like I said, what's the worst thing that could happen if you invest in, let's say even you let somebody borrow money as a private money lender into a home. You did your due diligence, the appraisal's there. Good. The borrower, something happens to them. The worst thing that could happen is you take back the money. But remember, they gave you 15 to 20% down to borrow that money.
Right.
So if you take it back, you can fire sell it. There's a big community of investors, Matthew, that if you don't want to do it because it's not your cup of tea, because you're a lender, you're not a landlord, you're not a landlord, you're a lender. But there's a whole community of investors that would be happy to just, hey, give you for what you bought it for, or let what you lend it out for, or throw in an extra 10% on top.
And just kind of save you from it.
Yeah.
That's good.
It's not gone.
Right.
That's why I love real estate, because it's backed by a hard asset. That's the reason why it's called hard money. It's not because it's hard to access money. No, it's because it's attached to a hard asset, which is a single family home.
I did not know that.
There you go.
Because hard money has such a negative connotation.
Very negative.
Yeah.
Very negative.
But it's not. It's a means to an end. It's a way to achieve your goals financially and all.
The stigma on that is high rates.
Right. Right.
But what?
And some of those loan sharks, I guess they could get kind of nasty.
No, they are nasty.
Yeah.
They are nasty. But now, for instance, I did a deal in 2019 that my wholesaler made about $75,000 off of me. But I made over 6 figures on that. So I'm not counting somebody else's pockets. I'm more counting my blessings, meaning if it wasn't for that opportunity, that made sense. It still made my numbers. I was still within my 70% rule.
Right.
Right? And we'll go into the 70% rule here.
Okay.
But it made numbers for me, because or else my lender wouldn't lend me that money, him making $70,000 on it. but it gave my family 6-figure return. That was crazy.
You were still the broker in that deal?
No. I was the investor.
You were the actual
I was
investor.
the investor.
I
Yes,
got you.
right.
Okay.
So
you flipped it? That's just the property you rehabbed and flipped? Good, man.
That's it, right?
That's a hell of a deal.
Right. Yeah. It's a hell of a deal because it made sense to me.
Right.
So I'm not counting other people's pockets. I don't care how much you could have made $1 million, but if I made 1.2, my man, give me some more.
Let's keep it
going. Yeah,
let's
let's keep it in rotation. Absolutely.
Yeah, that's cool. You mentioned the 70% rule. What is that? Tell us about that.
So the 70% rule is in every market. It's something that you do not disrespect. You stay loyal to that number. That 70% rule means that if you bring me a purchase price, a contract, a single family home, let's say just for easy numbers.
This is an offer. I'm making you an offer on a house. Okay.
Yes. 70,000 purchase and 30,000 in rehab, right?
Okay.
So I'm total 100 grand. That's my total project cost, right? Good. I divide that number by 70%. That 70% gives me what is called my after repair value. So 70% of 100 grand is like 142,000 and change. Okay. Good. That's my value after I inject 30 into this house. So how do I verify 142? I do two things. I get with my realtor. She or he's going to pull my comps. And my comps are going to give me, hey, this same house sold in this area at 142 or higher.
Okay.
So my realtor is probably going to tell me, Joe, yeah, man, hey, easily 155. So I'm like, good, because my threshold is 142. But if my realtor comes back to me and says, hey, Joe, in that area, houses are probably going for about 115 to 120. And I'm like, oof, I got to be at 142 at least. But you're telling me 120 is no deal. Why? Because I got closing costs.
Yeah.
You don't work for free. You have to charge your fees, your prep fees, your doc fees, whatever it is. Plus, I got to pay money on my origination points. So it doesn't make any sense. And also the appraisal is going to tell me what that value is. Even let's say I'm hard-headed. I say, I still want to go through it because I know I could do it at 155. The appraiser is going to say 115. And I'm like, it doesn't make any sense. And so like right now, investors are getting stuck because they're overpaying for properties just so you could say, I want to get in. Even like the first time investors, they're like, oh, I just want to say I want to get in. But there's more to it. You have to deal with contractors. You have to negotiate and coordinate who's going to come first. Is the painter going to come first before the floor guy? Or the floor guy's going to go here first? No, it's a lot that you have to take in. So just to make X. And we don't know what X factor is because you don't know what the market's going to be 6 to 12 months from now.
But you think that 70%, Rob, that's good. I think I'm looking back now. I'm not a big real estate guy, but looking back at some of the deals, I wish I'd have done that because I don't know.
No, and then you could work backwards.
Yeah.
What's backwards? If you know what your final price is, because your realtor's going to tell you, hey, Matt, in this neighborhood, prices are going $500,000. Then you take $500,000 and instead of dividing by 70, you multiply it by 70. So 70% of $500,000, I think it's like 350. Okay. Then you know that 350 is your budget to purchase and rehab a house.
Gotcha.
That is it. If you get that formula embedded in your mind as an investor, you'll be fine.
Okay.
Yeah.
That's cool, man. Very cool. All right. Well, listen,
guys, believe it or not, we're gonna have a Hines investment podcast.
It would be good. That'd be interesting because, like, a lot of people will ask, 10,000 is probably below what you're thinking with. But if somebody say has $100,000 to play with,
yeah,
you'd be like, go real estate.
100%.
100%. Like
100%.
No stocks. No. I guess depending on their risk aversion and their age and all, but if they 30, 40, 50, like.
It depends. So for instance, we have private money lenders.
Yeah.
They are letting people borrow from their self-directed IRAs at a 12% interest. If they would have left it in the money markets, they're probably getting 4 or 5%,
right.
Maybe high 6s, but they still got to pay that broker. Yeah. So yeah, they're making all this, but at the end of the day, you got to subtract like 1.7% of that money because it's paid out to the broker. And if the stocks tank, you're done. That money is done. That's not coming back.
That's right.
But if the market tanks and you have your money in a rental, your renter's paying you money.
Yeah.
And on top of that, your rental asset, you could do a cost segregation the Big Beautiful, what is it? Big Beautiful Act just came
That's
out,
right.
and that's 100% off rip. That's where you sit down with your tax advisor and say, hey, give me a cost segregation report, get me 27 years and a half, and work your magic.
Total. All right, we're running out of time, but that point, that's a big deal because we had 2 houses we just cost segregated, and I don't think most people know about that opportunity. It's huge. Can you tell us briefly what is a cost segregation on an investment home?
Okay, so I'm not a tax advisor. I'm not here to give any type of advice. I only know so much. I could definitely put you in with our person. She just pitched me a whole plan. Her name is Camille Vera. She's the owner of tax saving advisors.
That is so funny you say that.
Why?
That's who I'm working with on our houses. Vera Services, yeah. We'll give a plug for Camille. She's an angel.
She's amazing. Her and Todd, so amazing. Funny. No, let me tell you, because we cater to the Spanish market as well. So we're a bilingual firm. So it's a huge gap as far as education wise in our community. And that's where we're here, we're like the big brother, big sisters, because we speak English. It's an unserviced market. And she brings so much, like we're part of a lot of communities together, and she's one of my partners. Like I literally, like that's like my sister. And what she brings to the community, people walk out from her events like, I did not know I could do this.
Uh-huh.
Why wasn't I didn't have access? Well, we don't have access in the Hispanic market. And that's the reality of it. And I think it's our responsibility to bring that to our community.
That's cool. So is cost segregation is the term. Call Camille at Tax Savings Advisor. She can tell you about it. But you can get on any investment property, you can write a lot of that stuff off.
Guys,
and save a whole lot of money.
You have no idea that tool, how important it is.
Yeah.
Yeah.
Cool, man. Well, listen, my friend. Fascinating information.
Matthew, thank you for having me.
You're welcome. No, I'm glad you came and appreciate what you do. You're giving a lot of people big opportunities to like do something great.
Yeah, and
that's exciting.
And for those, we also have a Hispanic community called Nosotros, and it's a real estate investment community. So we teach strategic ways as to how to purchase properties through like creative financing, sub-2. Right now we're actually learning. We're going to be attending an event in Dallas to learn how to create notes. And we want to learn that so we could bring it onto our community as to how to create notes out of thin air. Right. So we're going to be going to events. We're hosting a PML event in Dallas to raise private money, how to become the bank or find money. People think you got to go to Bank of America or Chase to get money. No, the thing is you don't know how to ask for money.
Right. That's
so
true.
Like, it's like, for instance, like I can't go to you and say, hey, I need $100,000. And you're like, what? No, but if I have a pitch deck and I could tell you who I am, what's our mission, what's my ask, and what am I going to pay out, you're like, oh, I'm listening. Oh, yeah.
Nice. So you're talking about just to anybody. The pitch can be so good that no one can turn it down. They
can't turn it down because it's backed by real estate with double-digit returns.
Okay.
Nobody does that. Yeah.
That's interesting. Okay. That's fascinating. Yeah, we'll have to touch that one day. I like that. All right, everybody. Well, listen, thank you very much for joining us. Joseph, thank you for being here, my friend.
My man, it's a pleasure.
Yes, sir. So I hope you got some information. Take advantage of that. Call Joseph if he can help you. All right. If you've got that real estate vision in mind, you've got a house you want to invest in, he may have the solution for you. But we appreciate you joining us on Hines on Air. Always remember, please comment on the show, share it with your friends, give us a like, and we'll see you at the next Hines on Air.